Hey guys, Kylie here and welcome to the channel. Today I'm going to be talking about strategies for investing when there's a market crash. So there's been a lot of talk recently about whether the market is going to crash. The potential collapse of the Chinese real estate giant Evergrande has drawn a lot of parallels to the global financial crisis. And as we've seen throughout history, it's not a matter of if the market will crash, but when the market will crash. And there are a lot of indicators that suggest it could be very soon. In fact, Michael Burry, the same investor that famously predicted the global financial crisis, thinks we're in the biggest speculative bubble of all time.
Sincerely, Michael J. Burry.
Suggesting, of course, we could be in for the biggest crash of all time. So today I'll be talking about what you should be doing to prepare for it if you own stocks, and I'll be breaking it down into 5 basic steps. So before you start investing, everybody should have some kind of a plan, and that should include the steps you need to take if the market crashes. And just a heads up, I'm not a financial advisor, so don't take this as personal advice. Now, when we talk about a market crash, we're talking about a downturn of 20% or more. And look, it depends on the type of market crash we're talking about here, whether it's cyclical, event-driven, or structural. But historically, during a market crash, stock prices will continue to fall for anywhere from 9 months to 4 years on average. And it will typically take between 1 to 9 years for stock prices to recover to pre-crash heights. So when you're planning for a market crash, you have to assume that any one of these scenarios could occur at pretty much any time. In fact, Warren Buffett has a great piece of advice. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Because it's incredibly hard, if not impossible, to predict when a market crash will occur. So the idea is to have your portfolio and your finances prepared well beforehand. So the questions you should ask yourself are, what will I do with my current portfolio if the market starts to crash? Can I afford to wait for years before it corrects? And what will I buy if it does crash? As part of your plan, you need to look at how diversified your portfolio is. That means what assets, sectors, and countries are you mostly invested in? So I'll admit now to being a little too overly exposed to Chinese stocks. So when Chinese stocks fell across the board recently, as government crackdowns started, my portfolio dropped a pretty significant amount. If I had only been invested in Chinese stocks, my overall portfolio would have fallen by about 50%. Luckily, I'm also invested in Australian stocks, US stocks, cryptocurrencies, and ETFs. So all of these other assets have kept me in the green. So the lesson here is that some market crashes only impact certain countries or industries. But even when there's a global market crash, as we saw during COVID, some industries are impacted more than others. For example, typically banking and financial sector stocks tend to underperform when there is a market crash, especially during a recession. Meanwhile, consumer staple stocks tend to outperform the market. So diversifying is all about spreading your risk.
Keep it safe.
The GFC was disastrous for financial and real estate stocks, whereas commodities like gold and silver skyrocketed. The COVID market crash, on the other hand, was disastrous again for financial stocks, but also travel stocks. On the other hand, technology and IT stocks did very well, thanks to the very special circumstances. So to make your portfolio more diversified, it's just a matter of selling some of your investments and reinvesting into other areas. That's essentially what fund managers do day to day, except hopefully you'll only have to do this once or maybe twice a year, depending on your strategy, of course. Just on a side note, before you decide to go down this route, it does pay to take into account the investment costs such as brokerage fees for buying and selling stocks. Right, before my next tip, I just want to take a moment to thank everyone who's been supporting the channel. If you like this video, please like and subscribe so there can be more videos like this. Invest in defensive stocks and assets. So typically when there's a market crash, you'll see money moving around very quickly. It usually triggers a chain reaction where investors get spooked and move money out of riskier assets into less risky defensive assets. Stocks are considered pretty risky, so investors start to sell out of their stocks and either have their funds sitting in cash or they'll move their money into other defense assets such as gold or bonds. Or they might simply buy up more defensive stocks. Defensive stocks are companies whose products always do well, regardless of the economic situation. So we're talking about companies that people need, such as utilities like water, electricity, and the internet. Consumer staples like food and clothing. And there's also healthcare stocks. So good examples of defensive stocks include Procter & Gamble, Johnson & Johnson, and Walmart. The inverse of this strategy would be to cut back on growth stocks. Growth stocks can be very fragile during a crash because they're so future-oriented. Investors will buy into growth stocks on the idea that in the future there'll be bigger companies. But when that future starts to look bleak or uncertain, growth stock prices tend to plummet rapidly. For example, at the start of the COVID-19 2020 market crash, you saw even tech stocks like Square, Alibaba, and Netflix suddenly crash much faster than a lot of other stocks did. It wasn't until people started to catch up and they realized how important these stocks were in the current environment, considering most people were stuck at home, that they started to jump up again very quickly. Consider going global. Market crashes don't affect all countries in the same way, and stock market recoveries can also differ between different countries for the same crash. For example, Australia took almost double the amount of time the US stock market took to recover after the global financial crisis crash. With this in mind, owning stocks across different markets can really pay off. The Asian financial crisis is another good example of this, where multiple local stock markets imploded due to a range of financial issues, leading to the collapse of currencies and asset prices. I guess the point here is that stock exchanges around the world are volatile, so it's a good idea to protect yourself against any market going south. If you're not already living in the States, America's stock exchange can be a pretty good proxy for the global economy, so you could, for example, consider owning some US stocks. Or you could invest in a global exchange traded fund, or ETF, which allows you to invest in hundreds of stocks listed on overseas exchanges through one investment. Make sure you have enough cash sitting on the sidelines. As a general rule of thumb, you should always have at least 3 to 6 months of funds sitting in cash. That's before you even start investing. The COVID-19 market crash is a great example of why this needs to happen. In this case, the crisis saw a lot of people lose their jobs very quickly. So imagine if you'd lost your job and had most of your savings, which you needed very urgently, sitting in the stock exchange, and the market had also crashed. You might be forced out of desperation to sell some of those stocks at a loss to your initial investment. Having enough cash set aside in the case of emergencies not only means you're tied over until the market corrects, it also means you have the opportunity to invest in new opportunities that come up, such as stocks that have fallen to discount prices. That leads me on to the next point, which is to make sure you have a list of stocks that you'd like to buy if the market does crash. So this might be a list of stocks that you would buy if the price was lower. Maybe you think the stock prices are too high now and a market crash is a great time to scoop in and buy them at discount prices. So during the COVID-19 2020 market crash, I took it as an opportunity to buy up a lot of major blue chip stocks. To me, these were good buys because I knew that they would bounce back. I knew that the crash prices were only temporary. So I bought up major banks. I even bought up major tech companies like Google.
Google needs us, and Google wants us.
Prices have subsequently risen back to pre-crash levels and have made a great profit. So when the market does crash, make sure you have that shopping list of stocks ready. Make sure you have your limit orders set so you can buy in when prices are low enough. After all, even though a market crash can be really scary, it's also an amazing opportunity. So to wrap this up, look, it's really impossible to predict a stock market crash. But the point is that you should already have incorporated a potential stock market crash happening tomorrow, today, anytime. When you think about your overall investment strategy, a market crash should be part of your strategy. And it shouldn't be seen as something that you should fear, but as something that you could use as an opportunity. So think about your plan, diversify your holdings, and have some cash on the side for potential emergencies and opportunities that will inevitably come up when the market does crash.
So it begins.
So that's it from me. I hope you got something out of this video. If you did like the video, don't forget to like and subscribe so we can continue making more videos just like this. And if you've got any questions or comments about other videos you'd like us to make, then feel free to leave a comment in the comments section below. When do you think the market will crash? I'd love to hear from you. That's it from me. Bye.